Over the last year, Cathie Wood has turned from the next Warren Buffett into the most visible casualty of the speculative tech wreck. In fact, ARK's largest fund, its innovation fund, has now lost 3/4 of its value. So some people think that presents quite a bargain. So let's look at ARK Funds and whether now's a good time to buy them in a bit more detail. The turnaround for ARK has certainly been spectacular. In fact, all of their funds follow pretty much the same trajectory, which was a sharp sell-off in February of 2020, followed by an incredible rally during the Pandemania rally. But then in February of 2021, something changed. The appetite for her kind of stocks suddenly disappeared, and very rapidly the value of all of her funds fell very sharply, such that today 3 of her funds, so that's ARKK, the main fund, but also ARKG, which is the Genomic Revolution Fund, and ARKF, which is the FinTech Innovation Fund, are all below where they started in 2020. Now, a popular graph which has been making the rounds on Twitter is the one which you can see beside me. Here it's actually posted by Tier 1 Alpha, but there are multiple versions of it. And what it does is it overlays ARKK, the innovation fund, with the NASDAQ during the dot-com bubble. Of course, you have to scale the graphs appropriately. So for the NASDAQ, we look at the period between 1998 and 2003. And for ARKK, we're looking at the period since 2016. But once you jiffle the graphs together, you can see the spooky similarity beneath me. So ARK is in red, the NASDAQ is in blue. Now, naturally, what people think is, well, what happened next for the dot-com bubble? Well, if history does repeat itself, it doesn't look great. There was a bit of a rally after the dip that you can see here, but then it continued falling for some time. So if it did follow that trajectory, ARKK would carry on falling all the way through to the end of 2023. So you're probably thinking, well, surely it would have recovered fairly quickly. Well, actually, no, it wouldn't in the case of the NASDAQ composite. If we look at the time taken for it to recover its previous peak, it actually took over 15 years. And if we're thinking about such long periods of time, you really have to consider inflation. So if we inflation adjust the value of the NASDAQ composite, the recovery time actually gets much longer. It goes all the way almost to 18 years. You can see that once we've had a huge peak in euphoria, the time taken for things to recover can be very long. But ARK isn't alone in having suffered such large drawdowns. In fact, Goldman Sachs maintains a basket of stocks called a non-profitable tech basket, and in fact that's suffering its worst drawdown ever. It's down by almost 70%. ARK has received a lot of criticism because it seems to buy stocks regardless of valuation. Now, there's a brilliant website called cathiesark.com which drills into the fundamentals of her funds. And the 2 lines which are beneath me, which are interesting, are the ones in blue and pink. The blue one shows the price to sales ratio, which is often used to value tech companies, even if they're loss making, because of course the top line is still positive. They have to generate positive sales. That actually peaked, that valuation measure, around summer of 2021. And it's been falling ever since. And it fell very sharply in March of this year. So that's certainly not as extreme as it was just 6 months ago. And the pink line shows you the percentage of companies which are loss-making. That's gradually been falling also, although it is still well above 20%. If we look at an equivalent ratio, which is enterprise value divided by turnover, so that's roughly price to sales, what I've done here is I've compared the stocks in ARKK with the ones in the NASDAQ 100. And you can see that ARKK isn't that much higher. Its median enterprise to turnover ratio is 6.7 versus 6 for the NASDAQ 100. There are still some stocks which are very highly overvalued, but it doesn't make up the majority of the stocks in the fund. So certainly the valuation extremes have reduced in Cathie Wood's stock selections. However, would it sell off more? I think there's a lot of room for small cap growth stocks to carry on falling, because if you actually look at their valuations in the Russell 2000, that's the blue line here, you can see that they're still significantly higher than value stocks in the Russell 2000. Now, of course, not all of her stocks are small cap growth stocks. They are growthy, but not all small cap. Tesla, for example, is a mega cap. But still, I think this style of investing, growth, still has further to fall in terms of the dispersion with its historic averages. People are usually willing to pay more for growth, but at the moment they're still willing to pay far more than usual. And I suspect that premium will also mean revert as we see interest rates rise and the Fed normalizing policy. In fact, what we're seeing right now is a huge style shift away from growth, and that's probably a lot to do with what the Fed's doing. So what I've shown here are all of the different combinations of small cap, large cap, but also growth versus value for the US stock market using individual ETFs. And this covers that period of euphoria after the pandemic sell-off. Notice how the funds which are doing by far the best are small cap growth stocks, as characterized by the ETF called IWO. Mid cap growth also performed very well, that's IJK, and even large cap growth performed very well. And notice that there's a big break between those growthy small cap stocks at the top and the quality and value stocks at the bottom of the graph. So large cap value, for example, is actually third from the bottom. Since the beginning of this year, however, there's been a complete reversal, with high dividend yield and large cap value performing the best and small cap growth performing the worst. Now, the standard explanation for that is that growth stocks have much more of their value in the future. And that means when interest rates increase, you're discounting those cash flows much more heavily than you would for, say, a value stock, where a lot more of that value is closer to the present day. So while it's the case that interest rates will carry on increasing for some time, then that's not a great look for growth stocks, and it's not going to be an easy time for Cathie Wood either. If you want to learn more about these different styles of investing, like growth stocks and value stocks, then why not do that as part of our PensionCraft community? You can do that now on our website, PensionCraft.com. You also get access to lots of other goodies, like our Slack channel, so you can ask a question anytime you want, but also our members-only videos, an ever-growing library of content to which only you will have access. To learn more about that, just click on the link beside me and in the description beneath me. But what's truly remarkable about Cathie Wood is the strength of belief in her stock picking ability. To see an example of that, in April 2022, ARKK had its worst monthly return of almost minus 29%. And yet a few days after that awful return was posted, you can see there was a huge single day inflow. This was on May the 3rd of 2022 of $367 million. So it's certainly not true that people are capitulating and pulling their money out of Cathie's funds. Far from it. The belief seems to be something like, surely it can't get any worse, this must now be a bargain. And yes, of course, money chases returns. So the green bars you can see here are money flowing into ARKK, and this is on a weekly basis. Notice that the scale here is $1 billion. So during that incredible period when the returns were huge, of course there were huge inflows. And as the huge positive returns turned into negative ones, of course that switched into outflows a lot of the time, but it hasn't been a consistent pattern. There have still been weeks in which there have been big inflows. And if we look at the period in 2022, there have been fairly consistent inflows except for this 3-week period. So there is still plenty of believers in Cathie out there. Until recently, UK investors didn't have access to Cathie's funds. All we could do was buy a similar fund called Scottish Mortgage Investment Trust. This has a similar ethos of investing, which is to go for disruptive tech stocks, which are at the forefront of some kind of trend. And you can see if I plot the returns of that since the beginning of 2020 versus ARKK, they're very similar. Scottish Mortgage is shown in blue and ARKK is shown in red, and it rallied a little bit less than ARKK, but it's also fallen a little bit less. Perhaps that's as a result of its structure, because it's an investment trust which is closed-ended. That means that lots of money can't flow into and out of the fund. It has a fixed amount of capital. So it's never a forced seller if there are outflows. If people want to take out their money, they have to sell their share to somebody else. Also, it's got its own board because it's structured as a company, and the job of that board is to ensure proper risk management, and they could even fire the fund manager if they do a bad job. So these are the reasons why I like Scottish Mortgage. It's certainly on my market crash shopping list, but I haven't bought it, or at least not yet. But I am keeping a sharp eye on it for a turnaround when valuations are a little bit cheaper. In the UK now, we also have a suite of funds issued by leverage shares. And as the name suggests, you can go for leveraged exposure to ARK funds. So if ARK isn't risky enough for you, you can get a daily 3 times fund, which gives you 3 times the daily return on ARKK, for example. And you can either go long, so you make money if the share price goes up, or you can go short, which means you make money if Cathie loses money. So I've plotted the returns of the long fund in blue. That's a 3 times levered long fund. So if when it was issued in December 2021, you'd have invested 100, that would now be worth just £8. And that's a loss of 92%. Over the same period, if you'd have just bought a simple tracker, you'd have lost about half your money with ARKK. On the other hand, if you'd have gone short, that's a 3 times daily short fund, you'd have turned your 100 into 264. Now, personally, I'd never touch these levered funds because I think ARK itself is risky enough. Also, I wouldn't necessarily short ARK, even though I don't love the fund, because it can be subject to very rapid increases in value, which would lose huge amounts if you go for the 3 times daily short fund. So really, these are kind of gambling funds, and I certainly wouldn't go anywhere near them. And I recommend that you don't either. So in conclusion then, first let's consider the reasons why you might want to buy some of these Cathie Wood funds. I'm always amazed by the fact she's so transparent in her analysis of stocks. You can really read her thoughts about any stock either via her regular emails or by reading her reports. You may not agree with them, but at least you can see what her thought process is exactly. And she never buys a stock without a good justification, at least in her eyes. She's also been very consistent. When people lose money and they see outflows, sometimes you see style drift, where they see what they've got right now is not working, so they change their spots. Well, Cathie's never done that. Cathie is Cathie, and that's what's great about her, but it's also a problem for some people as well. But at least she's consistent. And finally, she provides thought leadership. Everybody wants her to come and talk at conferences. You're watching this video because Cathie's interesting, not because I'm interesting. And in fact, you could almost think of her funds as their own style, Cathie Woodsy style. It's more than just growth and tech, it's her own thing. And finally, I like Cathie Wood's funds for the same reason I like Star Trek. It's a kind of belief that technology can solve problems and you can invest in those solutions. And for someone who's a bit nerdy like me, that's a very attractive prospect. And if we consider the reasons why you might not want to buy her funds, well, I'd say the primary one must be that she is price insensitive. She'll buy stocks at any price. And the natural consequence of that is that the long-term returns are smaller. As many people have commented, their risk management at ARK seems to be lacking somewhat. Cathie doesn't seem to have that extra layer of pushback, people around her who'll say to her, no, Cathie, this is a bad idea. Or at least that's the way it seems. And while her marketing ability is completely unquestioned, she has an amazing ability to convince people to give her money. That seems to be greater than her ability to pick stocks. Or at least that's the way it's looking right now. And my final concern is to do with that regime shift. Growth did incredibly well during that period of zero interest rates, but will that continue now that the Fed's going into its hiking cycle? That's going to be an uphill battle, I think, for Cathie and other growth funds. So I'm not convinced now's a great time to buy Cathie's funds. They're a lot cheaper than they were, that's for sure. But I don't like the fact that the fee is always paid whether they succeed or not. I also don't like the cult of star managers. I think that's unhealthy. And we've also seen that she has very little governance in terms of pushback to stop her doing crazy things. But if you love Cathie, you like her style of investing, then certainly now's a better time to invest, and maybe you could dollar cost average into her funds. Now don't forget our offer for our membership. We now run that on our website, PensionCraft.com. And if you want to learn more about that, just click on the link beside me and in the description beneath me. And as always, thank you for listening.